Hey guys, let's talk about the 2016 market crash that may or may not happen. And let's talk about it from a very practical viewpoint. The reason I'm making this video is because there's too many videos on YouTube right now that talk about a 2016 market crash from the perspective of politics. They say things like, Obama's got a conspiracy out, he's poisoning your food, and that kind of stuff. That's not what we're going to talk about. We're going to talk about some actual methodologies to determine whether a crash is going to occur, and then what to do to protect yourself from a crash. So I'm only speaking to people who are invested or plan to invest in the stock market in 2016. Now, let's start with some basic ideas. The first is a lot of people are worried about oil. They're thinking oil prices are going down and that's going to make the market drop. Now, this is a problem of correlation versus causation. Oil prices are correlated to the strength of the dollar. And usually, yes, when oil price drops, that's a bad sign for the economy. But in this situation, we're looking at a very different reason for oil prices dropping. Usually when oil prices drop, what it means is the economy's hurting. Why? Well, if oil prices drop, it means demand has dropped, which implies that people aren't flying so much, people aren't driving so much, companies aren't using oil to produce things so much. In 2016, the low oil price is not caused by a lack of demand. Instead, we're looking at it oversupply. And an oversupply is drastically different. Here, we're looking at an intentional oversupply at the hands of OPEC to make a lot of American oil companies go bankrupt. They're basically trying to kill their competition. Now, that has driven prices downward, but that does not mean there's a low demand for oil. The demand for oil is met, more or less, equally with the supply at this point, and we're seeing what would probably be a normal oil price if everything worked out fairly. Alright? So, don't worry about the oil prices. Now, that said, it's not to say that because our oil price problem is supply-based and not demand-based, there's not going to be a market crash. That's not true. There will probably be a market crash in the coming future. I'm thinking 2016, and I'm going to tell you why. Alright, so let's go back to this oil and dollar relationship. As the dollar gets stronger, oil gets weaker. That's been correlated for a long time. Now, why is a strong dollar dangerous to the US economy? Well, first of all, if you look at companies that are making money overseas, and they're American companies, well, when they report their earnings, they're going to have a Forex problem. They're going to be making a lot of money overseas and then converting that money back into US dollars, paying out dividends and so on, and that's going to hurt the bottom line. For example, the company Aflac makes about 80% of its earnings, 80% of its revenue comes from Japan. Now, if 80% of your revenue comes from Japan and the exchange rate has fallen like 20 or 40%, you're going to see your revenue also fall 20 or 40%. Now, when you have lots of companies that are working overseas, which most American companies are now not just focusing on domestic issues, but they're also trying to make money overseas, when you have this kind of situation, what you get is a lot of companies reporting falling earnings, and that's going to hurt the overall stock market. We haven't really seen that much except for Q4 earnings reports in 2015, and we're starting to see them at the beginning of 2016, which is one reason the market has dropped. We also see the stock market in China having had a big problem, and this is all interrelated. Nowadays, stock markets are connected internationally, and if you have a stock market crash in China, you're very likely to have a stock market crash in the US. Now, here's one of the international problems that's not related to the dollar, but somewhat related to the dollar. Most emerging markets are not doing so well. They've kind of topped off their growth. Most emerging markets are copying the US instead of doing their own type of innovation. That's a problem for them, especially when they want to import from the US, because now everything is going to be more expensive because of a higher dollar. That's also going to hurt companies who want to export abroad, because those companies abroad, say in China, are going to look for cheaper alternatives. They're not going to buy so much from the US. That's going to hurt even domestic US companies. And we're seeing this right now. We're seeing big layoffs in the US. That's going to lead to more unemployment, which also hurts the economy. So we've seen companies like IBM lay off lots of workers. We've seen Yahoo just made a report that they're going to be laying off 15% of their entire workforce. So things aren't going so well for US companies. Now the fundamentals behind the stock market at the moment are not that great. Most of these Q4 earnings reports or 2015 earnings reports are not looking so good, and this should drive the market downward. Now what's not driving the market downward is keeping the market afloat, and there's multiple artificial factors that are keeping the US stock market higher than it really should be. So in this sense, most stocks in the US are overvalued. And they've been overvalued since this last 7-year bull market that we've seen. And keep in mind that on average, every 7 years or so, we have a market crash, and we're pretty much overdue. The last one was 2008. The one prior to that is 2000 exactly. And they've all been kind of cyclical. In addition, they've all had some of the same factors. For example, if you go and you look at the dollar index and you track it going back for every market crash if you want, but if you look at 2000 and you look at 2008, you'll see it makes this peak. It makes a relative peak right as the market crash occurs, and then it drops, and then peaks, and then it drops. And now what the dollar index is doing is it's peaking again. That's signifying the same kind of thing that happened in 2008 and happened in year 2000. So both of those situations were essentially bubbles. And we are seeing a similar type of bubble. In 2000, we had a bubble of tech companies, companies that weren't really making money. They were all about speculation. They started to go bankrupt, and then investors, mainly traders actually, because it's mostly speculative money that pumped up the 2000 stock market, they pulled their money out and everything dropped. Now in 2008, we had a different type of market crash. It wasn't a speculation market crash, it was an investment market crash. These were long-term investors who put their money into the real estate market, and that crash and that bubble burst, sending everyone out because they pulled their money out. Now a similar thing will probably happen soon. I'm thinking 2016, and our bubble this time is more of a debt bubble. It's more of a not fake money, but money that shouldn't be in the stock market is being pumped in the stock market. What I mean by that is that the fundamentals behind the investment don't really make much sense. There's no reason to invest in a stock market where most of the stocks are overvalued. However, where else are you going to invest your money? China's not a good place, and if you will look at the regulations for Chinese people investing the yuan outside of China, they are very strict. However, that has not stopped most Chinese people from finding clever ways to take their money out from China and invest it into the US. If I were to drop a bunch of sandwiches on the ground and they all got dirty, but one of those sandwiches didn't really have that many rocks in it, most people would want to eat that single sandwich because they're hungry and there's no other choice. That's what we're seeing with the US stock market. It's the least dirty of all the sandwiches in the world. So people are putting their money into the US stock market because they don't really know where else to put it. And we're seeing the same thing with companies as well. US companies have been sitting on cash for a long time, and they don't really know what to do with that money. A lot of them pay out dividends, but what you'll see most recently is a huge wave of buyback operations by these companies. And what that means is these companies are taking their extra money and they're buying back shares. What that does is it makes each outstanding share worth a larger portion of the company, therefore making each share worth more money. So they're inflating the prices this way. They're not backing it up with more earnings. They're just taking their cash and buying back more stock, driving the stock prices upward. All of this is inflating a bubble in the stock market that isn't backed by fundamentals. It's backed by extra cash. It's backed by buyback programs. It's backed by foreign investors. It's backed by the Fed. It's backed by bad news that is kind of looked at as good news these days. And I'll give you an example as to how that works. Because the stock market is being pumped up by money and not by fundamental aspects of the economy, the more money that comes into the US, the better for the stock market. And when you hear news of more money coming into the US, when you hear bad news, for example, bad news in a certain economy is going to bring more money into the stock market or into the total stock market of the world, investors react as if that were good news. The example I'm going to give you is the new negative interest rates in Japan. So the Bank of Japan has declared a negative interest rate. So think of it like this. If I loan you $100, you usually will have to pay me back $110, right? In a year or so. But in this situation, I'm giving you a negative interest rate. You don't have to pay me back $110. In fact, I'll give you $110. I'll give you $10 to take my $100. Or think of it like this. I give you $100 and a year later you give me back $90. So it's giving people who hold money incentive to invest their money. Because if I hold on to it, well, I'm going to have to pay out interest, even though I'm the one holding it. So that's what a negative interest rate does. And because you're not going to be wanting to hold on to that money, you're going to want to invest it somewhere, the Bank of Japan is going to spur the Japanese to start investing their money. Now this really affects bigger businesses and banks more than anyone, but still we're going to see a lot of money be pumped into the US and the Japanese and other stock markets around the world, and that has pushed stock prices up even further. Again, this is all bad news. This is artificial inflation. Essentially what the Bank of Japan is doing is a stimulus program. They're putting out free money. And when you're putting out free money to stimulate the economy, obviously there's a problem with the economy. So, in conclusion, here's the practical takeaway of all of this. The economy of the US is not looking good, but the stock market is very high. Now, that should be a contradiction, but it's not, because the stock market's being pumped up by stimulus money, by the fact that there's nowhere else to put money. It's being pumped up by artificial factors, not fundamentals of the economy. The fundamentals of the economy are not looking good. So you have that contradiction, and eventually people are going to realize that, and we're going to see a crash that I can't predict the size, but the crash is going to be related mainly to debt. People owe money, and the stimulus money being placed in big companies. So what you got is a inequality where there's some companies sitting on money, they don't know what to do with it, they're buying back shares, other people are putting money in the stock market. It's just pumping up the stock to the point where there's really nothing behind it. And when people realize that, we're going to have a crash related to, I think it's probably be triggered by debt, but there could be a lot of catalysts here. But that crash is probably going to occur in 2016. So what can you do? Well, you probably should be hedged. What that means is you should have some portion of your portfolio dedicated to downward positions, short positions, so that if that crash happens, you're going to be safe, or if you're speculative, you're actually going to make money because of a crash. And you can do that by shorting stock, you can do that by buying put options. I have many other videos on this, check them out. You should also look into hedging so that before the crash does occur, you are safe, your portfolio isn't going to be hurt so much. Look into that. That's really all I have to say. Be hedged, and know that the crash is probably coming in 2016. Be prepared. If you want to be speculative and make money on it, look into puts. That's it. Please subscribe and I will make more videos. Like this video, and please tell me what kind of videos you would like in the future. That's the only way I know what to make videos about.